All right, my friends. So Greg asked me the difference between ETFs and mutual funds and what's the advantages and disadvantage of each one. Um, so let's talk about this. Actually, there are a lot of similarities in between them. So an ETF, exchange traded fund, is just like a mutual fund by and large, and that is a basket of holdings, be it bonds or stocks, I guess real estate investment trusts, anything that's kind of out there. Just like mutual funds, they're going to hold a basket of other investments products. So unlike an individual stock, you own 100 shares of Microsoft, or you own a bond of University of Virginia hospitals. This, you have a bunch of different stocks and bonds. So that's what an ETF is, and that's similar to a mutual fund. ETFs typically have 3 to 4 symbols in them. Mutual funds have 5, so that's one way you can quickly ascertain what is different. ETF have 3 or 4 because it's traded on, and actually 2 as a matter of fact, because it's traded on the market like an exchange, like a stock. So an ETF trades like a stock. That could be one of the advantages, or it could be one of the disadvantages, frankly. So it trades like you can buy it like a stock. So you can go back and say, look, I'm going to buy 100 shares of VO. I'm going to buy 100 shares of VTV, the Vanguard Value Index. You can do whatever you want, but that's how ETFs work. They sell throughout the day, similar to stocks do. Does that make sense? Mutual funds only trade once a day. That's it. They trade at 4. So you can buy it right now. It won't execute until later on tonight. Got a plane going overhead. So that's the difference there. The nice thing about mutual funds is they're open orders. They'll always take investments. That's one of the negatives, frankly, is because as a fund gets bigger and bigger and bigger, it's hard to replicate past performance. In fact, the Fidelity Magellan is a perfect example of that. Everyone sweats Peter Lynch. Well, when he was starting the fund, he didn't have any assets. So, he could, all it took was 1 or 2 good calls to make his performance look through the roof, simply because he bought, the pantyhose legs or something like that. I can't remember what it's called. And that one stock, went through the roof. And because there wasn't much assets, all it took was 1 or 2 good calls, and he's living large. But once you start getting up there, the billions of dollars, you're not going to get the ability for one stock to really make or break your career. And you look at the managers that succeeded Peter Lynch, Jeffrey Vinnick as one. As another guy, I'm drawing a blank. Mansfield, maybe, I can't remember. But anyway, they floundered without question. They floundered, and it's not because they're poor investment managers, because they had so much money in Fidelity Magellan. So when you have an open-end mutual fund like that, and you're just chasing returns, and the fund gets bigger and bigger and bigger, it's going to be tough to replicate those returns. It just is, and that's one of the reasons why Vanguard Prime Cap. I don't know if Capital Opportunity, but like the Prime Cap fund was tearing it up, and they closed. I think it still has been closed for a long time to new investors, because they knew if we get too big, we can't replicate our past performance. Essentially, that's going to dilute the returns to shareholders that would have been in there for the long run. Fidelity Magellan should have done that. Another reason why I like Vanguard over Fidelity, Vanguard will close funds when it gets too big. They'll close actively managed funds, Capital Opportunity, Prime Cap, and things of that nature, because they know the whole point about active management is you got to have the nimbleness to be able to go after a certain stock, because that can make or break you. When you're an index, it doesn't matter. You're just literally mimicking the index, so they can take all the assets they want without question. Now, what happens on the ETF, though, because it's not open-ended, you're literally buying shares. Sometimes you could buy a share that has a different price than the true net asset value of the underlying holdings. And you'll find a lot of ETFs in closed-end municipal bond funds, or particularly muni bond funds from Nuveen and whatnot, that these are closed-end funds or ETFs. A lot of times the price that you'll pay today won't be truly reflected of the underlying holdings in the portfolio. I think people make more out of that than it needs to be, but there could be value there. So you could buy it at a discount of 15% relative to the NAV, which is simply the net asset value. How much are the assets worth in that portfolio relative to what it's trading at? So if it's trading at 100 or trading at 85, but if they were to hold and sell everything relative to the market price of all the holdings they have, they could get 100 for it. you're buying it at 15% discount. A lot of people think, oh, that means it's going to come back up, and there's no proof of that. We don't know. I mean, it could, but it might not. It might stay at 15% discount for a reason. So that's how ETFs. So a mutual fund is just traded according to the assets underlying in there every single day at 4 p.m. An ETF could have a premium or a discount. A lot of ETF, well, I don't know about a lot. It used to be the Nuveen ones. Back when I was doing it, the closed-end funds, they weren't ETFs, but similar, is that they only issued a certain amount of shares. You could get some pretty good discounts in there, and if you got lucky, you can make a lot of money. I mean, well, a lot of money relative to the bond price or the bond yields and whatnot. Not likely to happen very often. I would not bank, hey, I'm buying at a discount. This means I have inherent opportunity for upside. I don't believe that'd be a worthwhile endeavor of yours. But I mean, there is some validity to saying, hey, I like this area. I like this concept of the investment world. And the fact I can get it as a discount would only add more, maybe kick in the pants to do it. That makes sense. So just look at ETFs, discount relative or premium relative to the actual underlying value of the shares. There's a value there for sure, potentially. You can't bank on that. Mutual funds don't have that. Mutual funds, because they're open-ended and they trade only once a day, there's no discount relative to the share price. So that's ETF. ETFs just tax much more efficiently. No other way around that. There's some rule in the ETFs abide by that makes them much more tax efficient than open-end mutual funds. I'll talk about it. I can't remember what it's called, but there's some kind of structure that they can follow that when they sell a stock for a gain, they don't pass a capital gain to the shareholders. They do an in-kind transfer of a new stock they're buying. So much more tax efficient outside of an IRA or 401k. At this stage, it's hard to make an argument to buy a mutual fund, an open-end mutual fund over an ETF, given the tax benefits of an ETF relative to a mutual fund. Inside an IRA, it doesn't matter. It's all coming out as capital, as ordinary income anyway. But when you have a mutual fund, and I'm telling you, I cannot stress this enough, many times you're going to get a tax distribution, a 1099, even though you didn't sell the fund. Many times it will be significant too, significant tax distributions, even though you didn't sell the fund. And many times, just like last year, your portfolio could be down for the year, but you still got a taxable distribution because mutual funds sell and buy and sell and buy throughout the year, and gains have to be passed to the shareholder, you. So even if you bought it at 100,000 and now it's down 10% to 90,000, you could get a 15,000 taxable distribution. And you're like, whoa! I lost $10,000. Well, you haven't lost $10,000 if you haven't sold it. The issue is you are ultimately responsible for the taxes that previously people did not pay. It's the person holding the wet bag. You're the end user. You own it on a certain date, what's called ex-dividend date, capital gain date, the distribution date. You own the shares on that day. You are thus responsible for the taxes, even if you just bought it the day before. That's called, you don't want to buy the dividend. You don't want to buy the capital gain. So if you just bought it this year and you're down 10%, all the gains that they've unrealized from the last 15, 20, 10 years, whatever, that they realize this year are being sent to you, even though you've only been the holder of it for that 1 year, if that makes sense. That's a big issue with mutual funds, man, that you are ultimately responsible for the previous unrealized gains from many years previous, before you're even born, maybe. And now, because you own it on the dividend, the date of distribution, you will pay the tax on it. It's crazy. Which would I rather? The thing about ETFs, with the mutual funds, there's usually no commission to buy in. I mean, no commission in terms of a buy or sell transaction. USAA, for instance, will charge you, I think, $45 on a Vanguard fund. A lot of firms don't do that anymore, and I imagine USAA, because they're going away from their brokerage firms, will probably get rid of that at some point. But generally speaking, mutual funds don't cost you anything to buy or sell. ETFs do. I mean, you got to buy $4.99 for 100 shares of VOO or whatever it is, $4.99 to sell 100 shares of VOO or whatever it is. So there's always a buy and a sell on both sides. A commission that you're paying, no different than buying 100 shares of Microsoft. Mutual funds typically don't have that. With an ETF, you need a brokerage account. So you got to set up a brokerage account with the Vanguard, USA, Fidelity, Schwab, whatever. And you got to buy it just like you're buying an individual stock. With a mutual fund, you can just literally open an account with T. Rowe Price, with Royce, literally any firm that has a mutual fund. You can buy the funds through them, and a lot of times they don't cost any money whatsoever. And it's easy because you can actually dollar cost average into mutual funds. I'm going to send $50 a month into the mutual fund. That's hard to do with ETFs. That's the biggest drawback about ETFs. If it costs you $4.99 a trade and you're only doing $50 a month into the ETF, that's not, I mean, that's basically, that's 10% of your $50 a month is going to the commission. So you don't want a dollar cost average into an ETF. You do want a dollar cost average into a mutual fund, though, because it's open-ended and there's no transaction cost for doing that. Hope that makes sense. A lot going on. If you have more ideas on that, let me know, guys. If the experts on ETFs versus mutual funds, ultimately, just to narrow this down, ETFs are more tax efficient. They're less efficient from a dollar cost averaging perspective, where I'm sending money to them, or the alternative to that, where I'm taking money from it. Mutual funds are much more efficient in that regard, for sure. In terms of fees, everyone says ETFs are cheaper. Not necessarily. I mean, they're just as cheap as what the management team is charging. But I guess that's all I want to say on that. All right. Hey, thanks for the question. Thanks, Greg.